Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glen Sutherland. This week, I have my repeat. I don't know how many times you've been on the podcast. At least four, maybe? I don't know, 3, 4. Anyway, Chris McEvoy is back. Chris, first of all, before we get into this, you want to introduce people, let them know who you are.
Yeah, so my name's Chris McEvoy. I'm the owner of Leap Accounting Consulting and Tax, so Leap ACT as it's usually known. We're a cross-border tax firm specializing in cross-border real estate investors. And so, we have the privilege of serving many of Glen's students as well as real estate investors all over the world. And I'm happy to be here as always.
Yeah, and Chris is actually my accountant for the Canadian side as well. Chris, okay. One of the big questions I'm getting like emails about, I'm getting people texting me, people, they're seeing the news and they're a little concerned about Donald Trump's big, beautiful tax bill, or I think that's how he calls it, big, beautiful bill. First of all, maybe let's talk about what it is. What is he trying to propose?
Sure. So I guess I should preface this by saying I'm not a lawyer, I'm an accountant. But with that said, I'm going to give general commentary on it because there's a lot of tax-related things in it. The bill itself is quite expansive. It covers a lot of things. The part that's got Canadians concerned and people all over the world is the Section 899. So Section 899 of the so-called the One Big Beautiful Bill is the part that has all of the possible proposed changes to things like withholding taxes, which affect essentially any investors who are invested in any way, shape, or form in the USA.
Okay, so first of all, like he's talking about withholding tax, and there's already a personal withholding tax of FIRPTA, right? So is this like a tax that would go on top of FIRPTA or as a replacement of FIRPTA or something completely different? Maybe I just misunderstood it altogether.
Sure. So it's not really proposing at this point new taxes. What it's proposing is to change the rates on all the existing taxes. So, for example, Canada has a tax treaty with the USA. What this is really doing is rewriting those rates. So, for example, let's say someone lives in Panama and Panama does not have a treaty with the USA and they receive a dividend from a US investment fund. They would be subject to a 30% withholding because there's no treaty, whereas a Canadian currently benefits from the lower 15% rate. Right. So it's quite common for Canadians to see that 15% rate of withholding on, let's say, something like a dividend from a US investment. And so what this legislation proposes is to start walking that up by about 5% per year over the next few years. So that what is currently a 15% withholding could, in theory, over the next few years, go up to a 35% withholding. And the same with FIRPTA. There's in this proposed legislation, it proposes increasing the FIRPTA as well as any other source. So this covers things like dividends, FIRPTA, and a few other things.
Okay.
Under the tax treaty, Canadians can claim a foreign tax credit for U.S. taxes paid. So if someone paid, let's say, a tax rate on like a 15% on a dividend, they would typically get to claim that in Canada. And so normally there isn't a lot of complaining along those lines because as long as your Canadian tax rate is higher than 15%, which it often is, the math would sort of work like you owe Canada 20%, you've already paid 15 to the US, so you owe Canada another 5. Right. Whereas the system starts to break down if that rate gets too high, because if your Canadian tax rate is 25% and you've actually already paid 35 to the US, which is not necessarily refundable, you might ultimately end up paying that higher 35 because Canada would certainly not refund you the difference, right? So this is where these tax treaties and foreign tax credit systems start to break down, and this starts to cost people something, at least theoretically.
Theoretically, yeah. And what is the likelihood? I know that we don't know this. It's a complete guess, but what's the likelihood it's going to pass like Senate and this will actually go through? Are you looking to invest in the US? Are you looking for a coaching program that will actually save you money and help you avoid mistakes? My students get discounts on lawyers, attorneys. If you're looking to get an E2 visa, if you're looking for certain software, if you're looking to even speak with CPAs, I have discounts for all these things. If you want to just get on a quick phone call and we can discuss if it's a fit for you, 10-minute phone call, go to glensutherland.com or at CanadianInvestingInTheUSA.com and book a call. Or what do you feel about that?
So we'll get out the crystal ball and we'll speculate here a little bit. So one thing you'll notice is that it's hard to find an article about this thing without it referencing the digital services tax.
Yes.
And so this section of the big beautiful bill is really viewed as retaliatory. So the implication there is that, the US wants countries that have a digital services tax like Canada to remove that. Because essentially we're taxing US companies that are selling their digital services into Canada, essentially. This affects things like platforms. And so the US views this as unfair. And I mean, I should even amend that. The current US administration views this as unfair.
Yeah.
The US is probably a little too broad, but let's say the current US tax administration views that as unfair. And so the implication here is if we take off ours, then they're not going to do this. So similar to the tariffs, it could be very short-lived depending on what the Canadian tax regime does. The other thing I'll say about this is it doesn't start overnight. Like it's proposing a 5% walk-in over the next few years. So it's not that overnight it's going to jump right from 5% to 50% or something like that, but it is going to slowly keep going up over the next few years. And so one thing that people can do now about this is they can review how they're structured, and they can also review how they take money from the US back to Canada. And this is probably an area that doesn't get quite enough attention a lot of the time is, when I put my money into my US structure, is it a loan? Is it equity? When I take money back, is it dividends? Is it repayment of a loan? Is it capital? Am I charging interest on money that I've lent into the US? And so some of those practices and some of those planning points, which oftentimes don't get enough attention, the higher this dividend rate gets, the more important those sorts of things will be, because the subject of how you move money from A to B or back from B to A becomes really important if there's a very high withholding tax on some things but not others.
That makes a lot of sense. So people should get a good accountant that understands this.
Yeah, for sure.
And one thing that just pops in my head too is like when we're talking about FERPTA, right? A lot of times setting up a corporation can make you exempt to FERPTA in certain situations. Would something like that work with this, or this is completely different because it's more of like income tax rather than like, but it is still a withholding tax, right?
Yeah, so the bill or the section 899 of the big beautiful bill does suggest increasing those FERPTA rates. And so for those who already have good US side structures, they don't have to deal with FERPTA anyway because they're structured as domestic entities. So to some extent, having good US side structuring just becomes that much more important. I mean, FERPTA was already awful, and if they increase the rates, it just gets even more awful. The wait times on FERPTA, ultimately, it's a withholding tax, not a final tax, but it's not uncommon for people to wait 6 months, a year, sometimes more than a year, depending on how complicated their transaction was, or if there were any issues with the original tax slips, which sometimes there are, depending on who created some of the tax slips. So, for example, it's not uncommon in the US for someone to use a realtor and a title agent instead of a lawyer, or perhaps a property manager. And sometimes there are issues with the tax slips. And so depending on what happens there, someone could be waiting 18 months to get a FERP to withholding back after they file their tax return. And I mean, the higher that amount gets, the more financially onerous that gets, because you could be waiting a long time for quite a bit of money. So just sort of makes the existing best practice even that much more important.
Yeah, exactly. And it's sounding like, a lot of people are like, hey, you know what? I'll figure all this stuff out later. I'll buy it in my personal name. I'll do everything in my personal name. And it sounds like actually over time, the more laws that get introduced, the more important it is to get these things set up and running early in your investing journey in the US.
Yes, absolutely. I mean, there's just more and more good reason to have US side structures in place. Even strategic considerations like whether or not you want to bring your money back to Canada. This is always this differs a little. Some people like to do US items and they're trying to quit their job and they want to start bringing money back so they can live on it. Other people are a little more apt to want to let it roll, so to speak. They want to build their US portfolio. And so depending on which way this goes, it could mean that there's, tax-wise anyways, much more of a penchant for, leaving the funds in the US and letting it roll as opposed to bringing it back. But then you have to consider your own personal financial planning and so on. So depending on which way this goes, it sort of pushes the strategy in one way or the other.
It's just another question to like plan this out and have that discussion before you start. You can come up with a plan that'll make sense for what your strategy is, right? And even the way your structure is set up might be slightly different, and the way you move your money might be slightly different. I think it's just having the right people on your team to plan this out so that you are doing the correct way to make business work the best way.
Yeah, absolutely. And this is the main impact on real estate. There are a few classes of things that would be affected by this. I mean, you can imagine if something was like a pension fund or something, and if they have US stock or US holdings allocated through there, at a high level, there are even believe it or not, the Canada Pension Plan has US investments. And so, I mean, one can only imagine the impact on large institutions and so on of this thing. So this is one reason many people think that this might come to a swift conclusion or a swift negotiation. But, option B is always that people are going to reallocate their holdings. Some people may choose to divest their US holdings if this really carries on long term.
It doesn't sound like it makes sense, honestly, for the US to even put this through. Are you looking to buy property in the United States, but not interested to travel there just to sign the notary? Did you know there are 6 different ways to sign notary as a Canadian, and only 2 of them involve going to the United States? To get my free guide on notary, go to CanadianInvestingInTheUSA.com/notary.
Them not wanting to pay the Canada Digital Services Tax, which weighs out against, other large funds that may decide to divest US holdings. So, similar to the last round of tariffs, we saw, there was a lot of pushback actually from Wall Street. Like the stock market didn't like a lot of those things, and ultimately they didn't necessarily go away, but they were reduced and took different forms, and many of them were eliminated. So the final form of what ended up happening there was a long way from what was initially proposed, we'll say, and the same could end up being true with this legislation. It could be that, and honestly, like more countries than just Canada are considered in this bill. Like this isn't a Canada specific legislation. This is what the US wants from Canada with regard to the digital services tax, but different countries will make different decisions based on how invested they are with the US, how close their trading relationship is. Some ones that maybe have a smaller holding might just say like, no, we're just going to reallocate our assets to some other thing, whereas a country that's heavily invested like in the US, like Canada, may choose rather to negotiate or play ball, so to speak. Just because divesting, billions of dollars of U.S. holdings may not be feasible at certain levels. But coming back down to the more personal level, you're correct that there's quite this is sort of one of many issues going on right now, whether it's exchange rates or withholding taxes, market volatility. There's certainly a lot to consider, and there's always opportunity in there somewhere.
When I was reading about this, they kept using the term "bad countries" in the terminology. Is there a chance that Canada might not be on the list of bad countries?
So I think we are on the list mainly for that one item that has been referenced a few times, the digital services tax. So truthfully, it doesn't take much to be considered a bad country. That's not a deeply philosophical comment on like the state of political affairs in Canada or something. It really just boils down to we have one or two taxes that affect American companies that the current U.S. tax administration doesn't like. So it doesn't take much to be on the list, and it doesn't take much to get off the list either.
It's a little wild. Hey, was there anything else I should have asked you about this big bad bill? Any notes that you had on your side that I didn't cover?
No, I think that was pretty much everything. Other than to say that treaty countries and non-treaty countries are being affected alike. Canada sort of has a lower starting point because we benefit from those treaty rates, but I can only imagine the non-treaty countries that start off perhaps with somewhat higher withholding rates. Let's say someone was living in Panama or some other similar country and was already had someone getting a dividend subject to a 30% tax. Over the next few years, that could be headed for like a 50% withholding tax, depending on where that goes. So that becomes extremely punitive for some people. As Canadians, we sort of have a lower starting point because of the treaty. But this proposed legislation still kind of negates a lot of the long-standing treaty rates and treaty agreements, and really represents, a renegotiating of that tax relationship, which again is why it puts so much uncertainty into the investment market.
Okay, I love that. That's a good way to summarize that. Chris, if people are like, "Hey, I need to make sure my stuff is straight. I want to make sure that I have the proper corporate structure just in case this comes," or even, you know what, you should be having the proper corporate structure either way to have to make the most sense for your taxes, your liability, or even just wanting to work with you or having an accountant that is experienced and understands this. How do they get a hold of you? How do they track you down in order to work with you?
The best way to get a hold of us is go to our website, www.leapact.ca. So that's www.leapact.ca. Fill out our web contact form, and somebody will get back in touch with you to set up a time to talk.
Awesome. Thank you so much for all this information, Chris. I think with a lot of this, it's important to have the information instead of just listening to the news and then getting the panic side of it all, and just understanding what it could be and what options you could have, which I think is gonna help calm a lot of people.
Yep, absolutely. Pleasure as always, Glenn. Thank you.